Welcome to our new video series. Today we'll do an introduction to forwards. Forwards is an important financial instrument in derivative finance. This video series is especially targeted to the student of undergraduate level of Pokhara University of Nepal. Regarding the derivatives market, I'll start a basic about derivatives. These are the contracts which return are derived from the another financial or another commodity. These instruments are called financial derivative instruments, which doesn't have their own prices. Their prices are dependent to something else. So the performance of these assets depends on something else. That's the crux we have to understand at the starting of this video. So regarding the derivative, it can be dependent upon almost anything, any variable from price of a soybean or pork or like gold or crude oil or something else, interest rate or forex. So we'll be starting a series on the derivatives, and this one is the first series on derivatives. At the beginning, we'll have a short introduction on forwards contract, or simply we called it forwards. So forwards are the simplest form of derivative contract. It's an agreement between the buyer and seller. It's an agreement between the buyer and seller, but this agreement is conducted at now, and the transaction is conducted on a certain date in future. So this contract works like contract works in a format that you have a you enter into a contract at, let me write here, you enter into a contract at T0 and you'll perform the contract at T1. The duration between this T0 to T1 can be any day, any amount of day. That's the thing you have to understand. You'll just be performing the contract here. You'll just enter into a contract here, and you will be performing the actual action. Actual action means if you are a buyer, you have to pay for the underlying assets, or if you are a seller, then you have to deliver the underlying assets at T1. So you just enter into the contract at this date, or today. You can call it T0. So while entering into the contract, you have a specification of the underlying assets. What kind of contract, what kind of assets you will be delivering on the future day is specified on T0, so that there will be no doubt about the underlying assets that is going to be delivered on future date. For example, if you are trying to deliver a kilo of gold, 1 kg gold, then it's specifications such as like it can be 22 carat or 18 carat. This has to be defined on the contract that is conducted on the initial date. So the next point is that there is no involvement of actions. There is no mediator between one is buyer and there is a seller. So there is no third party existing in the middle of this contract. That means there is no involvement of actions, no involvement of brokers or anything else in the contract. The contract is conducted directly between buyer and seller. So there is a counterparty default risk. The buyer can uh, get defaulted at the future date, or the seller can get defaulted at the future date. This is an inherent characteristics of forward. You have to understand that mm, the default risk is very high in forward contract. So the counterparty default risk of either buyer or seller is borne by the another counterparty, either buyer or seller. In general, you have to understand forward as a type of very basic financial instruments where a contract is written on a initial date, and there is an agreement to deliver certain goods, commodities, or something else in a future date, and the specification of that underlying assets is done at the initially done at the contract on the contract date. And when the future date or the performance day comes, or the maturity period of the contract comes, at that period you have to deliver the goods to the buyer, and buyer have to pay for that underlying assets. This is the basic concept of the forward, and this is how the forward contract work. There is no any involvement of exchange or any third parties. So there is an inherent characteristics of high default rates. So if we segregate the works in present date and future date, we can find that in the present date we'll conduct an agreement. We'll first write an agreement, and the next is um, on the agreement we'll try to buy or sell certain product. We'll mention about this thing. Either you are going to buy or you are going to sell about the underlying assets. As I have mentioned earlier, let's take the same example. You are going to sell 1 kg of gold, then you are a seller of this seller in this contract, and there will be someone who is going to buy 1 kg gold, is the buyer. The buyer has the contract has there should be mention of such things like who is going to buy and who is going to sell the product, the underlying assets. Forward price is determined. This point is very important. On the forward, I haven't mentioned the time here. Let's take an example of like 6 months. So you are going to sell, you are a seller, you are going to sell 1 kg gold in a 6-month period, and you'll have to the price has to be mentioned at the initial date. Let's say 1 crore rupees. This 1 crore rupees is the forward price. Regardless of the price that goes changes in the 6-month period, you have to buy at 1 crore rupees, and the seller have to sell at 1 crore rupees. The buyer has to pay 1 crore for 1 kg gold, regardless of the spot price after 6 months. The point that you have to remember is the spot market price can be anything. It can be either more than 1 crore or it can be either less than a crore, but you have to pay exactly 1 crore after 6 months for 1 kg gold. I'll mention about something else later. So this point should be clear for you now. After this, the forward price is determined at the present date. Description of the product is defined. So I have mentioned only 1 kg gold. I haven't mentioned, if I mention only 1 kg gold here, and you may be expecting 24 karat gold, and if I deliver only 18 karat gold, then what will happen? So you have to specify the product as well. Sometimes you may specify the brand as well. Sometimes you may specify the other things with associated with the product. Here I take this 18 carat or 22 carat or 24 carat as a specification of product. So I mentioned 22 carat gold, 22 carat gold of quantity 1 kg to be delivered after 6 months at rupees 1 crore. Now this contract seems to be perfect. It may not be fully perfect, but it seems to be perfect, nearly perfect. Date is defined 6 month. This can be 6 month. Have mentioned in general terms, but you can specify always as like 1st October 2020 or something else with a very clearly and defined date. So no actual transfer of goods or commodities takes place in a present date. The seller will not be transferring any goods or commodities on the present date. So these are the things that you have to understand what is going to be happen on present date. And let's move towards the future date, or you can simply say this one is T0, and let's move towards T1. So in the future date is the maturity date. Here the execution of the agreement should happen. The buyer should buy the good. That means the buyer have to pay for the good or commodities or underlying assets, and the seller has to deliver that good. The seller has to deliver that good. The execution of agreement means the buyer has to pay for the goods, and seller has to deliver the good. The contract is going to be executed in this future date. Buyer pays the predefined amount regardless of the market price, at that day. Seller transfer the assets after receiving that amount, regardless of the market price. Transfer of ownership of goods or commodities or services or something else. This can be anything. The ownership has to be transferred from seller to buyer. Alternatively, cash settlement can also be done, but this can be also an alternative, but we will not go on the depth of this point. So now you have to now you should be clear what is going to happen on the future date. The contract is going to be executed. Buyer is paying for commodities, and the seller is delivering the commodities, and the transfer of ownership is going to happen on this date. Let's think about the real life scenario. We'll carry this example. You have 22 karat gold to be delivered on sixth month period, and the price has been mentioned as 1 crore, that's rupees. If you are not familiar with 1 crore is like 10 million. However, this is very common in Nepal and also in India. So after 6 months, let's say the price of 1 kilo gold, 1 kg gold is 1 crore and 10 lakhs. That is 11 million. You agreed to sell this goods on 10 million. The real price on the market fluctuated to 11 million. If this is the real life scenario, and you can saw if you can see that if you are selling in the market, or if you are selling in the outsider, then you'll be receiving 11 million rupees or 1 crore 10 lakh rupees. However, you have an obligation through the forward contract, so you have to sell this contract at 1 crore. You have to sell this contract at 1 crore. This is your obligation. However, if there is the price of 1 crore, sorry, if the price is like 90 lakhs, that is rupees 9 million, you initially have the contract to buy the gold at 10 million. However, the price after 6 months in the market is 9 million. If you are going to buy this same 1 kilo gold from outside, from the market, then you have to pay only 9 million. However, this contract has an obligation, so that you have to pay 9 million you have to pay, sorry, 10 million rupees, or 1 crore rupees to the buyer. You cannot walk away from the contract. Let's discuss something about counterparty default risks. What's counterparty default risks? Default risks. Should be familiar with this term. If you are a finance student with a specialization in finance and raised to this level of reading financial derivatives, then you should be very familiar with counterparty default risks. There is the high chances of counterparty default risks in forward contract, because at the maturity date, the buyer may not be ready with the money, or the seller may not be ready with the goods or commodities to deliver. If either of the party is not ready with their obligation, then the counterparty default risks exist. Then that arises. So you should be very careful while making an agreement. While making an agreement, you should be very careful. Make an agreement with someone else, and the counterparty default risk arises, then there's no point of making such agreement. You have to bear the losses. We'll discuss this a bit in depth later. Let's move to the next slide. Key characteristics. So, what are the key characteristics of forward? This may be the question to you. Briefly written these points, and I'll be describing them in very general. It's a contract. It's a bilateral contract between buyer and seller. As I have mentioned earlier in the introduction section, that there is no third parties or no involvement of exchange, or so this one is a bilateral contract. There is only buyer. This is buyer and seller. It's a contract between buyer and seller. Buyer will pay for the good, and seller will deliver the good. This contract is a customizable contract. This contract is a customizable contract. Since the contract is conducted in T0 of the initial date and is performed later somewhere in the future, so if the buyer and seller are agreed to customize about the contract, about the conditions of the contract, then they are customizable. they solely depends upon the intention of buyer and seller. If the buyer is ready and the seller also agrees with certain terms and conditions, then they can be changed, they can be modified, or we can say this is a tailor-made contract. Customizable actually can be done in terms of maturity date, in terms of specification of contract, in terms of quality or grading of underlying assets, in terms of quantity of assets or underlying assets. If the buyer and seller are if the buyer and seller agrees to certain modification, then they can do it. So the contract is tailor-made. Possibilities of default risks, as we have discussed earlier, it is a key characteristics. If the buyer is not ready with the money, or if the buyer is not ready to buy the underlying assets on the maturity date, or if the seller is not ready with the goods or commodities on the maturity date, then the default risks arises. This default risk is solely borne by the either buyer or sellers, the parties involved in the contract. So this one is key characteristics of forward contract, and we can also call this possibilities of default risks is a downside of forward contract. Another characteristics is neither the party can walk away unilaterally from the contract. You enter into a contract, and before reaching to the maturity date, you cannot say that, okay, I will get out of this contract. I'll not fulfill my obligations. You cannot say like that. You have the obligation, and you have to fulfill those obligations mentioned in the contract. You cannot walk away. You cannot either transfer your rights or obligation to the third party. In the contract, you have certain rights and obligation. You cannot unilaterally transfer these rights and obligation to someone else. You have to understand this. You cannot transfer your rights and obligation to someone else unilaterally. If the counterparty agrees, then you can transfer these rights, but you cannot do it unilaterally. So these are the key characteristics of forward contracts. Let's move to the next slide. Forward price. You can see this simple equation on our screen. A value of a forward contract on the maturity date can be calculated. Listen once again. Value of a forward contract on the maturity date can be calculated value of a forward contract on the maturity date can be calculated from the spot price of the contract of the underlying assets from where you deduct the forward contract value that is written at day zero and the delivery cost of the underlying assets. So at the maturity date, this one is the maturity date, and you are trying to calculate the value of your forward contract. You will not know about the spot price at day zero. You will not know about the future spot price at day zero. You'll only be able to know the spot price of that current time. So you'll not be able to know the spot price at day zero, future spot price. But you'll be able to know this spot price ST at time T. So you have this information and you'll remove the value of forward contract. And if there is some delivery cost, you have to deduct those delivery costs as well. From this equation, you can calculate the value of forward on maturity date. This should be clear. This is a simple equation. We'll move to the long and short forwards. Long forwards is a contract that guarantees, long forward is a contract that guarantees to buy the underlying assets. You have to remember this. While we say long contract, long forward, then you have to remember this point. Long forward is a contract that guarantees to buy the underlying assets after a certain period at a pre-specified price. This type of contract is written when there is an expectation of price rise. So short forward on the reverse is a contract that guarantees to sell the underlying assets, guarantees to sell. When we call short forward, then you have to remember it guarantees to sell the underlying assets after a certain period of time at a specified price. This type of contract is written when there is an expectation of price decline. So let's elaborate this with an example. If the current price of let's say gold, 10 gram gold, 10 gram gold is 50,000, and you think that your expectation is that the price of gold is going to rise in next 6-month period. So you are going to write a forward contract, long forward contract. You are going to enter into a long forward contract. And the long forward contract, when you enter into a long forward contract, that means say that 6-month, 10 gram gold, let's say the price of 6-month forward price of gold, 10 gram gold is 55,000. Then if you write this contract, then after 6 months at rupees 55,000 you can buy 10 gram gold regardless of the market price. Market price can be 60,000 or 70,000 or 80,000. Regardless of this market price, you can buy 10 gram golds at 55,000. On the other hand, you have an assets like you have 100 gram gold. You have 100 gram gold and you think that the price is going to decline. Think that price is going to decline. So after 6 months, you want to be sure about your future trade, and after 6 months, let's say the current spot price S0 of 100 gram gold is how much? 6 lakhs. That is 600,000. 600,000 is the spot price of gold, and your expectation is that gold price is going to decline. So you want to be sure after 6 months when you have gold in hand of 100 gram, then you want to sell that gold. So you'll enter into a short forward that will guarantee to sell your underlying assets. Then you'll enter into a contract of, like, I don't know, it can be let's say 6,000, let's say 585,000. 585,000 is the forward price for gold. Then your expectation is price is going to decline. It should not be less than 600,000. It can be also 5 F06. It can also be 650,000. It can be anything. Okay, it can be anything. So yeah, this contract will guarantee you this price after 6 months, but you have to deliver this 100 gram gold. If the price movement goes opposite towards your expectation, then you have to bear some losses. In the long forward also, if the price movement is towards the opposite direction of your expectation, then you have to bear the losses. Same to the short forward also. If the price is moving to the opposite of your expectation, then you have to bear some losses. Let's move towards the next slide. Long and short forward payoff. Here the slide seems empty. I have a small diagram to make here. This is very simple and should be very clear to you. In fact, long and short forward diagram can be incorporated in the same figure. This one is contract date. So I have a dotted line here because there is no initial transfer of either goods or services. Someone is going short and the reverse party is going long. But forward, long, forward, sorry. You can write it same here. I don't know, I haven't given any example for this payoff. Let's say 10 gram gold whose current spot price is S0 is 60,000 and contract is done for a 3-month period, or we can say F03 is done at rupees 62,000. 10 gram is the quantity. I haven't mentioned about other specification. What will happen at the maturity date? Maturity date. The person who is on a long forward will pay cash. Pay cash. How much? 62,000. Okay. And the person who is staying short will deliver 10-gram gold. Okay, this is a very simple diagram. If ST, it can be more than 62,000 or it can be less than 62,000. Let's assume it is 65k for 10-gram gold, and I'll say about this later. If the spot price is 65,000, then what who is going to be benefited? Think about this. Who is going to be benefited? The person who is staying on a long forward is paying only 62,000 for 10-gram gold, which is trading at 65,000 in the spot price. Or, in other words, the person who is staying in a short forward contract has to deliver 10-gram gold at 62,000, has to deliver 10-gram gold at 62,000, which is trading at 65,000. So the person who is benefited 3,000, so this person is in loss of 3,000. Got my point? If the market price is, let's say, 55,000, if the spot price after 3-month period is 55,000, then the person who is staying on a short forward contract is selling 10-gram gold at 62,000. The person, let's say me this once again and make you more clear. The person who is staying on a short forward contract is delivering 10-gram gold at 55,000. Sorry, the person who is staying on a short forward contract is delivering 10-gram gold at 62,000, whose market price is 55,000 only. So he's in a profit, or he's benefited 7,000. On the other hand, the person who is staying on a long forward contract have to buy a 10-gram gold at 62,000, whose market price is only 55,000. That means he suffered losses. This one, 7,000. So this is the payoff for short forward and long forward. Long and short forward payoff. Mathematically, the long forward and short forward payoff can be written as, long forward payoff, forwards payoff, long forwards payoff equals to spot price minus forward contract price, and short forward payoff equals to forward price written on the contract minus the spot price. Should be clear with this notification. F0 indicates the forward price written on the contract. ST is the spot price. If you want to write it down on your note, ST is the spot price at T time T time T, and F0 is the forward contract price. Graphically, this thing can be presented in this graph. I've already made the graphs, so I can save some time. The long forward and short forward payoff. The long forward is colored with this red one, and the short forward is colored with this green line. So the payoff, the profit from this above from this previous slide, we can get that in short forward, when F0 in short forward, when F0 is greater than ST, then we'll reach to the situation of profit. Okay, and from long forward, when when ST is greater than F0, then we'll reach to the situation of profit. So the spot price should be greater in long forward, and the forward contract price should be greater in short forward. This is the situation. This has been presented in this graph. So forward, in short forward, the this green line is the forward contract price line, and which is initially written on the contract. In this one, let me describe it more clearly. The y-axis defines net payoff. Okay, this one is the payoff, and this also defines profit or losses. The x-axis defines the spot price of the underlying assets. This one is the spot price. When the spot price is equals to F0, that is the equilibrium situation. When the price written on the contract is equals to the spot price, then there is no point of writing the contract. You cannot get benefited from such contract. So this is also called equilibrium condition. In short forward, when you have a spot price less than forward price written in the contract, then you will have certain profit. Profit area is mentioned by this green color. In long forward, this is the profit area, and you'll have ST. See this ST. ST greater than F0. Is this the situation? So this one is the situation. ST is greater than F0. I'm giving you some time so that you can draw it in your copy or note. If you are not clear on this, you can always write down on the comment. So this one probably we have one more slide, not the last slide. This one probably is the last slide. So forward are zero sum game. This one is a very famous quote about forward. Forwards are zero sum game. Net payoff of a forward is equals to long forward payoff, sorry, plus short forward payoff. Long forward payoff plus short forward payoff is equals to the net payoff. From the previous slide of this one, long forward payoff is ST minus F0. Short forward payoff is F0 minus ST. We're going to is another ST minus F0. This one is long forward payoff, and this one is short forward payoff. So if you calculate this all of these things as t minus f0 plus f0 minus st, then you can cut this one equals to 0. There's nothing fancy. Net payoff is equals to long forward payoff plus short forward payoff. This means, in fact, how much the amount the long position holder is getting benefited, or short forward is benefited, that is compensated by the counterparty. So there is nothing spillover going somewhere else. Someone taking short position and making loss of more amount than someone taking long position with less amount benefiting. That means there is no spillover. Whatever the counterparty is making losses, that is the exact amount the another counterparty is making benefited. So this one is quite long video. I think I have covered almost many things. I'll try to do with the arbitrage issue on forward in next video. So that's all from my side. Thank you very much. Thank you all staying until this with me, and if you have any comments, you can always write it down on the comment box below. Thank you very much. See you on next video.